It's worse than we thought. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, we have new information that the economy in a certain part of this country is grinding to a complete halt. We're going to take a look at what's going on there and what's causing it to completely shut down. And plus, we have some other information that shows that this slowdown isn't localized to just a certain part of this country, that other regions are experiencing major slowdowns as well. And despite all that, the consumer is showing a lot of optimism, but what will it take for them to change their mind? Well, I'm going to show you that too. Now let's head over to Texas, where we pick today's story up. With the headline, the Texas manufacturing sector contracts slightly. This from the Dallas Federal Reserve. And I want to show you how this kind of gets spun a little bit, how the data, at least from the headline, looks okay. But wait till we get underneath the covers. Wait till you see what people in the manufacturing sector there are saying about what's going on in the real economy, and you will be completely shocked at how bad it is. Texas factory activity declined in February for the first time since May of 2020, according to business executives. The production index, a key measure of state manufacturing conditions, edged down from 0.2 to minus 2.8, showing a modest contraction in output. So there you have kind of the headline number saying, look, we just slowed down a little bit here. It's not a big deal, but wait till we dig deeper here. It's a whole lot worse than that headline number sounds. Other measures of manufacturing activity also indicated a contraction. The new orders index was negative for a ninth month in a row and moved down 9 points to minus 13.2. Of course, we've talked about how new order growth, if it's contracting, it leads to broad manufacturing sector and eventually leads to a massive amount of layoffs. Now, that hasn't started yet, but of course, we know that if this doesn't turn around, layoffs will soon follow. The growth rate of orders index fell from minus 12.3 to minus 16.9. The capacity utilization index returned negative territory after two positive readings, falling 10 points to minus 4.1, while shipments was largely unchanged at minus 5. So you get from the underlying data that what moved the headline number down a little bit, while underneath it looks pretty darn ugly. As perceptions of broader business conditions worsened in February as pessimism increased, the general business activity index pushed down from minus 8.4 to minus 13.5. The company outlook index has been negative for a full year and plummeted 15 points this month to minus 17.5. And yet labor market measures suggest relatively flat employment and longer work weeks. The only question, my friends, is when does that change? Now let's look at the comments from people responding to the survey, because those numbers, while the negative ones look bad and the headline ones suggest, hey, we're just in a bit of a contraction here, let's look at what the respondents are saying, because their outlook and what's going on in Texas is going to bleed out to the rest of the economy. And I'm going to show you why this is happening there and why it's going to spread. In the computer and electronics product manufacturing, we see after a slow start, we see a lot of new orders, but they believe that they're going to continue to grow. But look at this. I'm currently worried about the time I'm seeing it take for my customers to pay me, which I've heard from other businesses saying, yes, they're getting longer times before people pay. Let's look at the fabricated metal product manufacturing. There seems to be a lot of projects on hold or being deferred. And of course, that tells you if projects are being deferred, that means there's questions about either funding or viability, or if this is even going to happen. And deferral can often lead to cancellation. Of course, that would be bad. All markets served have slowed down and are ordering lower quantities in miscellaneous manufacturing area as quantities compared to last year. Paper manufacturing, we've seen this slowing in the last 2 quarters and expect the same moving forward. So again, broad-based slowdowns here. How about plastics and rubber? Revenue dollars per sale are going down as people watch their money. So again, you see demand falling here. How about the primary metal manufacturing? We expect recession in the second half of this year. We've already had our first round of layoffs, and we're looking at each employee very carefully to learn who may have to be in the second wave if And when business slows down again, which is the case that I've been making on the show, is that we will see more layoffs unless things turn around. And that is coming much sooner than people think. It may only be now a matter of a month or two before businesses have had enough and are forced to lay off more people. Of course, wait till we see how that will shift, at least consumer optimism, in a big way. But let's dig deeper because it gets even worse. It seems like someone turned off the spigot, this from the printing and relative support activity sector, as we have gotten quote unquote stupid slow as others in our industry. We're not sure if it's the Federal Reserve jacking with interest rates or some sort of cyclical slowdown, but it feels like business has ground to a halt. We have some nice work planned for later on this year, but right now we're just stupid slow. And February here, textile product mills has been a slow month. It's hard to know why, but our outlook has worsened for both businesses and retail activity in general. And so you get this picture that things are getting slow, stupid slow. Now, maybe how about your sector where you're working, or if you're in the manufacturing base, put in the comments. What are things going on with your area? Is it booming? Is it bust? Is it slow? What's going on there? Because what the issue with Texas here, it has everything to do with the price of crude, as you'll see on this next chart. Here we have current new orders, the diffusion index for Texas, and crude oil prices. Now remember, new order growth, it leads the broad manufacturing sector. So as new order demand goes down, we should see continued decline in the broad manufacturing base, and then eventually an increase in unemployment as businesses shed workers, as we saw in that one comment about having to look at a second round of layoffs coming. But here we can see that crude oil prices, going back to the great financial crisis, they rose. Now see, ideally they were here between this $40 and say $80 range, but that was just getting too high and it was causing a slowdown a little bit, but there was still demand. But once crude prices broke out of 80, demand started coming down, and then we hit a recession. Of course, we see demand in the manufacturing sector from Texas, new orders collapse, oil prices collapse, and then we'll look and see, you see as oil recovers, the economy there then recovers, demand is there. But now look here in 2015, 2016, oil prices come down, and look what happens to demand. It goes down and starts contracting, again suggesting that crude oil is a great leading indicator of the economy. We see demand for energy pick up, we see it happen in new order growth, crude oil prices slow down, the economy starts to slow. It's still growing, but at a much slower rate. And now look, crude oil prices coming down, demand crashing. The story in Texas, my friends, is all about crude. If crude oil prices do not start increasing from here, showing that demand is coming back, then what you're going to see is a further contraction in the economy, and as we'll look at soon enough, eventually layoffs. And that's what makes a weekly crude oil inventory so critical. We should get that tomorrow. We get that every Wednesday except for holiday weeks, and we're going to be watching that closely to see what's going on there. But it's not just Texas. The slowdown here is filtering out to other parts of the country. Now it's heading north over to Chicago, to the Windy City. And what do we see here? The U.S. Chicago Purchasing Managers Index. This determines the economic health of the manufacturing in the Chicago region. We want to see a number over 50 to denote an expansion, under 50 contraction. Notably, it was contracting at 44 last month, 43.6 this month, means it's further contracting from last month. Here you can see that slowdown, that contraction, eventually layoffs coming to the Chicagoland region. And it's not just there. Now we'll head over to the 5th District, and they've said their manufacturing firms reported deterioration in business conditions in February, according to the Federal Reserve Bank of Richmond. So now we're back east over into the Virginia area. Get this, the composite manufacturing index decreased from -11 in January to -16 in February. So again, you're seeing contraction in one region, contraction in another region, contraction in another region. It's broad-based. It's affecting everyone. The only question now remains is, when do the layoffs come? And unless this turns around, unless these minus signs start turning to a plus sign in the near-term future, you're going to watch. The layoffs will follow. The composite manufacturing index, we got that of the three component indices. Shipments saw the largest change, declining notably from -3 to -15. Again, a sign of demand falling. The employment index declined, but not a whole lot, from -3 to -7. Wait till that gets bigger. And new orders remain unchanged at -24. Again, a demand issue. The new orders are key here as firms remain pessimistic about local business conditions, but their expectations for the future increase notably. Of course, when things are bad, of course, we've all been there in a bad place, and you say, well, things just can't get any worse. They have to get better. And you're seeing the manufacturing sector now start to say, look, this is pretty bad, and there's no way it can get worse. The only question then we have remaining is, what if this soft landing isn't really a soft landing and maybe just a stair step down to the next level? Business continued to see declines in backlogs. Of course, that would be an inflation component, and lead times as both indices remain negative. However, the capacity utilization index fell notably from -7 to -17 in February. So again, just like Texas, we're seeing demand and the factory go down, and this is how much of the factory is being utilized. So when you're seeing less factory utilization, you see less demand, less need for employees. Eventually will follow. Let's take a quick look at what's going on in Richmond here. And what do we see? Shipments down, new orders down, backlog of orders down, capacity utilization down, vendor lead time down, local business conditions down, capital expenditures down, inventories up, raw material inventories up. The only thing you're not seeing is a big decline in employees yet. That day is coming, my friends. But for the moment, workers remain optimistic. We see from the Conference Board Consumer Confidence Survey, that went from 106 down to 102.9, a minor decrease. And you'll note that it's sitting right here where we got it circled in yellow. We can go back to prior recessions. Here you can see the dot-com bust was down here in the high or low 60s. We see the financial crisis got down almost into the 30s, but was hovering mostly between the 40s and 60s. So up here at 102, it looks really good. The question is, what will it take to change consumers' minds about their confidence in the economy? Well, as I mentioned throughout the show, the answer is layoffs. Here you can see on this chart the University of Michigan Consumer Sentiment Survey. Only because the Federal Reserve database doesn't have the Conference Board data, we'll overlay the 4-week moving average of initial claims, which we know follows with a lag, a decline in new order growth. And here you can see consumers remain confident. You see notably it's up here fairly high as unemployment claims are declining. Of course, they should be confident when they know they can get a job and they're not going to get fired. But look what happens as soon as claims start to rise, confidence goes down. We see that happen repeatedly. And the reason confidence is ticking higher or staying elevated here is real simple. People aren't losing their jobs, but wait till that day comes and you will see consumer confidence collapse, likely back to where it was during the great financial crisis. But for the moment, we're not seeing a soft landing. That is a message we want you to have today, is what we're seeing in Texas. If it is indeed grinding to a halt, as we're starting to see, and that filters out to other regions, as we're starting to see, this is an ominous warning. We're not facing a soft landing. We're facing a hard landing, not the second half of the year, but we're coming into the second quarter. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.